Beaulieu. Thank you for watching this edition of FedWatch. Today is June 23rd, 2023. Chairman Powell of the Federal Reserve testified before the House Finance Committee earlier this week, and his remarks were interesting. There were 3 points I want to cover. One, what's going on with future rate hikes. 2, the timing of decline or potential decline in interest rates. And 3, job concerns. So going back to number 1, Powell said, and I quote, "It's a pretty good guess that there will be 2 more rate hikes." Pretty good guess is the part that's in quotes. Probably each of 25 basis points. So what does this mean to our forecast? Really not much. We had originally 6-7 months ago or longer built in enough of a rate rise into our forecast that another 50 bips on the Fed funds rate isn't going to change our outlook. It will not make 2024 more severe. Certainly isn't going to make it less severe, but it's not going to make it any worse. So that was sort of interesting, but not problematic. Point number 2 is problematic. He's saying that they're probably not going to lower rates until the Fed sees inflation down significantly. And I put significantly in quotes. That's an ambiguous term. Who knows what significant means when you're the Federal Reserve? This is where they really stand out as academics not used to or involved with businesses and Main Street. You and I know from running businesses that we need these interest rates to come down to make sure the economy continues to move on. And they're not concerned about that. They are adamant that they think that they can maneuver this soft landing. They are continuing to forecast growth in the economy for 2024, which I think is whistling past the graveyard. I just looked at the U.S. industrial production forecast, and that 12-month moving average looked like it's going to peak in July or August of this year, and it will be moving into recession. GDP still on track for a 1Q 2024 decline, and that'll be the beginning of recession in GDP. Yet they're saying not until they see inflation come down significantly. Their timing is, as usual, less than ideal for anybody running a business. They were getting harangued about jobs also in front of the House Finance Committee on Wednesday. And pretty much Chairman Powell brushed those aside. He said they don't expect to see any mass layoffs, not much of an issue. We respectfully disagree. Our forecast is that employment is going to decline in 2024, which the Fed won't mind. They're just not going to be forecasting that themselves. And running a business right now, if you're gaining market share, I'd still be hiring. But if you're not actively gaining market share because of an existing market or you're moving into a new market, I'd be very careful about hiring. There is going to be some unemployment stress. We're looking at, although the media tells you otherwise, we're looking at some stress in the retail sales trends. So we suggest caution when it comes to hiring at this time. So the Fed's being the Fed. They're going to push interest rates up higher, probably. It's a good guess, according to Chairman Powell. They're not about to start lowering interest rates, which means we have a delay in unwinding this inverse yield curve. And that pushes off the potential of a 2025 recovery trend. Every month that they delay dropping those rates is another month that we'll have to contend with an ongoing recession. This is the big deal, the timing of those interest rates coming down and getting us back into a normal yield curve. Be careful about hiring, and I'll see you next week. Thanks for watching this edition of FedWatch.